So you want to learn how to trade options? Well, look no further. I got you. Welcome back to another video. This is one of my favorite topics, options trading. And so I'm going to break this down to you, remove all the fear from this, and teach you guys how to trade options in a very simple fashion, but effective fashion. But before we get into it and get started, I just want to say this is definitely a video where you may want to take notes. And I want to say that, on this road and on this journey between starting to learn options and becoming profitable, the bridge there in between is discipline. Because money will leave the hand of the impatient and go to the patient. So, with that being said, let's get into it. Disclaimer: trading has considerable risk. This information should be viewed as entertainment only. Please consult with a licensed financial advisor for all investment needs. I'm just some random dude on the internet. Alright, so in order to trade options, you have to have a platform to trade on. I recommend E-Trade for trading options for a couple reasons. It's very clean. When you're doing technical analysis, looking at charts, everything's very clean. When you're looking at your positions, it's just clean, and I just really enjoyed that. It makes it easy to kind of just see what you're doing. And in this video, we're going to be talking about mainly a longer duration type of option. There's options that expire the same day. There's an option that expire in the same week. But the primary focus here is going to be being a little bit more conservative and focusing on those longer term or longer duration options. And so the money required for that, it can be anywhere between, a few $100s to a few thousand. But I recommend having somewhere between $2,500, $3,000 to start off with. That way you may not be risking your whole portfolio at one time. So when we look at the important elements of options, we have calls and puts. So a call is implying that the asset will increase to a certain price by a certain time. A put is saying that the asset will decrease to a certain price by a certain time. Something else we have to look at is the strike price. So this is the price in which a call or a put can be exercised. So the price you want the stock to go to. And another important element is the expiration date. So this is the time. So the time in which a contract will need to be exercised, or the days remaining in this contract. There are four main functions of options. You got buying a call, selling a call, buying a put, and selling a put. For this video, we're going to be focused on buying a call and buying a put. So with all these, you can get as crazy as you want to and mix it up by buying a call, selling a call, and that'll end up being some sort of strategy. Or you can, buy a put and, buy a call at the same time. That's a different type of strategy. But we're just going to keep it simple for this and just focus on buying a call and buying a put, just outright. So another important element here is the moneyness. So we have at the money. So that's when the strike price and the underlying stock price are the exact same. So I put it little examples here. So in this example, let's just say Apple stock is trading, the actual stock itself is $150 and the strike price is equal to $150. And a lot of this will make sense when I kind of go over an options chain and show you what it looks like. And I'll do that here in a little bit. So moving on, we have in the money. So this is when the underlying asset is greater than the selected stock price. So in the example, let's say Apple stock is $150 and the strike that you select is $145. Okay. And then we have out of the money. So this is when the underlying asset is less than the selected strike price. So say Apple stock is trading at $150 and the price that you pick, the strike price that you pick is $160. Also, we need to understand the Greeks. That's what makes trading options different from just buying a regular stock. There's different factors that play into the price and how the price moves. One of the most important ones, really there's two main ones that I say I focus on, and that's the delta and the theta. And then secondarily, I'll look at Vega and Gamma, but I'm very keyed in on the delta and the theta. So going over delta, that's the estimate of change in the option premium per $1 up or down based off the underlying asset. And it also doubles at the probability of an option expiring in the money. And so that's what we want. We want our options to expire in the money. And so that is kind of a risk involved. So if your option expires and it's out of the money, you lose your entire initial investment. So if you put $2,000 in, it expires out of the money, you lose it all. Now, if the option expires and you're in the money or at the money, you should make some sort of profit. But a good thing is when you're buying leaps or these longer duration options, you're giving yourself more time to be correct. And so the time is the theta component. So when we look at theta, it's the time value decline as the option approaches the expiration date. Okay. So let's look at Vega. So that's the estimate change up or down based off the implied volatility. Okay. Then we have the Gamma. So that is the rate of change for delta. So in simple terms, the higher the Gamma, the higher the delta, the more money that you should make and or lose. But hopefully we're making money doing all this. And then let's look at implied volatility. So this is the metric that anticipates the likelihood of potential moves in either direction. So a higher IV usually equates to a higher premium, and the premium is going to be the price you pay for the contract. And when we look at options, one contract is represented as 100 shares. And we'll kind of go more into pricing here in a little bit. So here we have our option Greeks and the options chain. As the example on the left, we have SMH. We have SMH here. And so we have the expiration here. We have the days traded. We have 253 on this one. So with this being a out of the money play or an out of the money option that we're viewing, it does not have any intrinsic value. So you'll see as your option play move into the money, at the money, into the money, this number increases and just tell you the value that contract holds. So back to the 100 shares, one contract of this SMH will equal 100 shares, or one contract of anything will be 100 shares. We have the delta here. So you just move your decimal point over twice and it'll show you that you have a 58% chance or 59% chance of this contract expiring in the money. And we have our Gamma, and this theta is really low because this is sometime out in the future. And then pretty decent Vega, and then pretty low implied volatility right here. When you're looking at your longer term, your longer dated options, usually the implied volatility is a little lower. Okay. So this is an options chain. So when you look at an options chain, you usually have your calls on one side and your puts on the other. So this particular stock we're looking at, well, actually it's an ETF, QQQ, Tracks Technology. We have, you see this dark purple or this shaded purple, that lets you know that these are in the money on the call side. And as a call, you want you want your price to go up. So if you see the price of QQQ is $441. The strike price here is $440. So everything 440 and below is going to be in the money. Right here at the 440, because they're not at 441, is going to be at the money. and everything here that's not highlighted because it hasn't reached 440 yet is going to be out of the money. So when we look at the put side, it's inverse. So if you notice, these colors are inverse. So if you're placing a put, you actually want this asset to go down. And so as it go down or decrease in price, you'll either be at the money, in the money, or out of the money. And then also across the top here, you have your different time frames. So let's look at duration of trades. This is just a little vocabulary here. So a day trade, you're usually in and out of a trade within the same day. A swing trade, which I do a lot when it comes to options, you're in a position for multiple days, weeks, or months. And then the main focus of this video is a LEAP. So the LEAP stands for long-term equity anticipation securities. So usually all it's saying is it's an option position that lasts somewhere between a year and 2 years. Okay, so we'll look at some technical analysis, and technical analysis is just kind of the art of looking at charts to make educated decisions on where a price may go. So some of the things I use personally, I like to use different time frames, moving averages, trend lines, Bollinger Bands, supply and demand zones. But for this video, we'll focus mainly on just kind of getting comfortable with different time frames, using a few different moving averages, and definitely the Bollinger Bands. So just kind of just understanding those three things, you should be able to make some profitable trades out the gate. So let's take a look at that. Okay, so we're over here looking at Yahoo Finance. So we have the SPY ETF pulled up. So this tracks the S&P 500. So kind of getting familiar with the chart. You want to get comfortable with different time frames. So on Yahoo Finance, on the desktop version, the time frames are across the bottom. So right now we're looking at the 1 year chart. But a lot of times when I'm placing options trades or leaps, I'm looking at the 3 month to the 6 month. And it's the same thing, it just gives you a different portion of the chart in time. So let's look at we'll go back to the 1 year. Okay. So when you look at all this shaded area, this is what you call a Bollinger Band. So when we're using Bollinger Bands, I really like the fact that if you see it creep out either at the top, it's usually going to snap back in to the shaded area. Same thing if it creeps out the bottom. You usually see it snap back in to the shaded area. And then you have a high price, a midpoint, and a low point. And sometimes I will even use those points. I would use those points as a strike price. And so we have this green line here. And so this is a moving average line, and this is a 100-day moving average. So with ETFs, you usually see a drawdown. If you see a drawdown, the 50-day moving average is a good one. The 100-day moving average is a good one. And then if it's an individual stock, you can see stocks drop anywhere all the way down to the 200-day moving average. You usually don't see that with a solid performing ETF. So I like to use those as a gauge. So if I'm trading and I'm using an ETF to trade with, I'm going to have a 50-day moving average. If we breach that and move lower, I'll place a 100-day moving average on my chart. And you see here, kind of late April, early May, it just about touched that moving average line and then moved up. So like that would have been a great point to place a call, which if we were to go to the SMH chart, I actually did that. So when we're placing trades, you want to know what's going on in the market or in the news that influences how the market is going to move for the day or for a time period. So different news outlets I use are CNBC, Bloomberg, Yahoo Finance, Seeking Alpha, and Wall Street Journal. I'm listening to CNBC every day. On my ride to work, I have CNBC playing, and it just kind of keeps me in tune with what's going on in the world. And because things that go on in the world obviously affects the stock market. Another way to check market sentiment, and then when I say market sentiment, I'm just talking about what is the mood? What is the mood for the market? Like, do people think the market's going to go up and they're feeling good about themselves, or are people afraid and doing a lot of selling and are very fearful? So another thing I like to use is the CNN Fear and Greed Index, and I'll go in more depth on how I use that. And then another thing I like to check is the VIX, or the Volatility Index, and I'll talk about some levels that I like to look at in order to help place trades. Okay, so we're over here on CNBC, and as you see, it's just a place that has news everywhere. So it literally provides all the most recent events of what's going on, and a lot of these events do influence how the market's moving, or just kind of give you an explanation of why the market is moving in the way in which it is. And so, like, I use CNBC daily. Okay, so we're over here looking at the Fear and Greed Index, and this is a measurement of a gauge that goes from extreme fear to extreme greed. And let me show you how I use this. Okay, if the needle is over here at a fear or extreme fear, usually there's probably a lot of selling pressure in the market. And so with options trading, or just even buying shares, but specifically options trading, you want to buy low and sell high. So if we're hanging out around fear, usually prices are on sale. I look at it that way. They're on sale and they're lower. So I'm probably going to back up the Brinks truck if we're especially in extreme fear, but definitely in fear. Now, when the needle is like it is here in greed and in extreme greed, I still may buy a call. But especially as we get closer to extreme greed, my mind is shifting more from calls to potentially puts, especially if we're in certain parts of the market where it's just like been riding high for weeks on end, days on end. I might be looking more to place a put here. Okay, now we're over here looking at the Volatility Index, or the VIX. So I went ahead and put us out to a year. So we have a year worth of data up here. And so when the VIX is lower like it is, like right now, currently at the time of this recording, the VIX is sitting at 11 or roughly 12. So when you see the VIX at a level lower than 20, the market may be green, approaching all-time highs, usually doing well. So as you approach 20, like that 15, 20, anything higher than 20, you're usually going to see a lot of red in the market, a lot of selling. Back here in 2023 in October, we saw a lot of selling, and you see the VIX was up to 21. Here recently, you could see that the market had pretty much rallied. This shows you that the market was rallying from essentially October all the way up till late April. So that's how you use that. So as we approach the 20 mark, I'm looking to place calls because usually things are probably on sale. And that's my favorite time to place these leaps. Okay. All right. Let's talk about risk management. One thing you can do, and I highly recommend it, is to paper trade. So paper trading is essentially open up an account. You're able to get fake money and you can place trades with. But there are some pros and cons. So when we look at a pro, you're not risking your actual capital. So you're not risking your own money. The con to that is not being able to feel the emotional swings. So once you start taking some actual losses, that's when you'll kind of get that internal feeling like, ooh, I need to pay attention to what I'm doing. I need to stop being so emotional. I don't need to be so attached to the money. So I do recommend trading or paper trading for 3 to 6 months, but I know a lot of people probably won't do that. But if I'm going to skip out on paper trading, what I would recommend is probably start off with ETFs. The reason I say that is because ETFs move a whole lot slower than individual stocks. Like you may have a stock like Tesla, Nvidia, or something like that, and they may move, $20, $30 in a day. And that's a lot when we're talking in terms of options. But you may have a ETF like the SPY or SMH. They may move somewhere between $2 to $5 in a day. And that's a whole lot more manageable than having your position go up or go down that much. Stop losses. Stop losses. I don't really use stop losses when I'm trading leaps because there's so much time. If I'm trading anything shorter, like a month, 2 months, 3 months, right around there, I'll use a stop loss. But even if you're trading leaps, you should get in the habit of using a stop loss. And so essentially what that is, you'll put that order in, and if your position goes down to a certain percentage or a certain price, it'll just cash you out. You'll take your loss and you move on. I primarily use this right here, the percentage drawdown. So if I'm trading a leap or a 1 year position or even a 2 year position, if I'm down somewhere between 25, 30%, I'm evaluating this position. I'm just reevaluating the whole thing, and I'm pretty much thinking about getting out because that means I probably bought at the wrong time. And then what I'll do is I'll just take my loss, move on, reload. Okay, so now I want to show you guys some potential returns or expected returns when I'm trading leaps. So when I'm looking at a 1 year position, I expect somewhere between a 75 and 100% return. If I'm trading a 2 year position, I expect somewhere between a 200 and a 250% return. And so let's just look at some of the examples, or they're not even examples. These are real life trades that I placed and, remember to actually screenshot. I knew I wanted to make this video one day. And so we look at an SMH call I had here. And for the day, for whatever day that was, I was down $207 on that position. But total, I was up $1,600 for a 43% return. But also, I had a put placed. On the put, I was up 210 and for a total gain of 270. And then when we look at the total percentage gain, 21%. So in this instance, I was most likely in the call first, and then the market had ran up. It got to a point where I was like, okay, we're probably gonna have a little pullback, and then I placed a put. So I'm profiting in both directions at the same time. And then let's look at Nvidia. This is one of my favorite individual stocks to trade because it moves so much. But you do have to be careful with that. You have to be precise when you're using stocks with high volatility or high beta. So we look for this particular position. In a day, I was up 4,000. Total, I was up 6,000. Total percentage, 145% total, with 57% being up in a day. And also, if you look like this purple shading here, that lets me know that I'm in the money for that position, which is good. So that means if it expired on that day, I would make money. So here's another Nvidia position. I guess I was really excited because I highlighted everything here. But we look for the day, I was up 13,000, total gain 13,000. It went up, this option went up 400% for me, going up to 544% total, which is pretty good. I had another position down here that, it was going up for me. I was down at the time, and then this one did end profitable for me. Okay. And then the last example I have here is an SMH call option. So days gain 745, total gain 2,700, days gain percentage 12, and then total gain 72%. And then I've really enjoyed trading options because when you pair options trading with sound fundamental investing, and I always recommend having a starting five. So 2 ETFs, 3 individual stocks, dollar cost averaging or buying in every month into those. So when you have that set first as your base, and then you add options trading on top of it, you do become unstoppable. So here I'm going to show you guys how to actually open a position and then how to close a position. Okay, we're going to actually place an actual trade here. So we're using SMH. Going to do some quick technical analysis. Starting off with the 1 month chart pulled up. As you can see, I got the 100-day EMA, got the Bollinger Bands on there. We'll switch over to the 6 month. You can kind of see the trend there. ETFs are really good about bouncing off that 100-day EMA or moving average, which is that green line. So that probably would have been the best place to buy in, but we're going to keep it moving. So to get to the options chain, you click options chain. You adjust your date. We're going to go all the way out to January 17th. We're going to pick the 225 strike, buy open. And from this point, I'm going to select the number of contracts that I want. I'm going to go 2. If I were to put market order, it would put me in right at the ask price, that $24.45. But I'm going to do a limit order so I can be more specific about what I'm picking. And I really want to get in this trade, so I'll go somewhere in between. So I'm going to go 2,400. And so remember, options are a multiple of 100, so you move the decimal over twice to the right to get what you're paying. And you look at the estimated cost is $4,800. You submit it, view the portfolio, and you can already see that we're up $18 from the jump. So I'm just going to change it from standard view to option view just to show you what it looks like. See your quantity, the price paid, total gain, days gain, what symbol you picked at what price, days to expiration, the bid and the ask spread. We got all our Greeks. It's pretty good delta there, the 0.58 for something that has so much time. Theta is very, very small because we have a lot of time. We got 256 days till this expires. The good thing is you can cash out at any time. So if I wanted to take the $18, I could, but we're gonna let it cook for a little bit. All right, I'm gonna show you guys how to close a position. As you can see, we're up $200, total gain of $1,100. We're gonna hit sell close, select the price type and term. Make sure we're in the right account, we're in the individual account. We're gonna change our sell type from limit, and we're going to change it to market. You want to be more exact, more precise. You want to put in a limit order, but for this video, I'm going to go ahead and get us out this trade. Even though I had plenty of time, it didn't expire to June 20th of 2025. But I'm going to go ahead and get us out this trade so I can show you guys what it looks like. As you can see, my total proceeds are $3,200. Not bad at all. See, it's just that simple. Thanks.